And it doesn't matter basically like if you just got a smoking deal on a property and you're doing almost like the BRRR method, as long as you have the 25% built-in equity, the money doesn't have to come out of your pocket basically. So it's
No,
basically a perfect product that goes with the BRRR method basically.
but generally speaking, if we're doing properties, 100, 200, 400,000, even up to 1 million, we're not even asking for tax returns. We will look at your last 2 months bank statements and see how much liquidity you have on hand.
Hi, everybody. Jose Luis Morales here. Welcome back to another episode of the Morales Group Show. Today, we have a very special guest. His name is Brendan Ochinero or Ochinero. He is from Renovo Financial. And today, he's got a really important episode for us. He's going to be covering us what is a DSCR loan. So if you don't have any income, if you don't have a W-2, if you don't have a tax returns, but you found a good property that is a rental property and you want to make the loan work, this is the product for you. Welcome to the show, Brendan. How are you?
Good, good. Thanks for having me, Jose.
I love it. So for our viewers that don't know who you are, who is Brendan and how did you get involved in the world of mortgage lending and specifically products for investors?
Yeah, for sure. I'll give you a quick high level and try not to bore you too much. But I've been in the lending industry for about 12, 13 years.
Mm-hmm.
I came from a background in real estate for renewable energy. So
Okay.
acquiring properties for solar, wind, geothermal. I met my future business mentor and my first foray into lending at a line in Starbucks about 13 years ago. I heard him get off a phone call. We started talking in line. He asked if I wanted to sit down and talk more after. And I said, yeah, that sounds great. Fast forward like 2 weeks and I was working for him. And we started basically a startup lending company in a small 400 square foot room in Pacific Beach, San Diego, and
Mm-hmm.
started lending across the country on DSCR, fix and flip loans, new construction, spec builds, that sort of thing. So I've had a long history of lending in this space. I've started a couple investment funds. I've had my own mortgage shop before, and then Renovo and I met about 3 years ago, and they brought me on to manage both the Southwest in California and in Arizona. I'm extremely focused on California and Arizona, but the company Renovo is based and headquartered in Chicago, and we have a focus of being local to our markets.
I love it. And you guys are actually part of the Collective Genius Mastermind. And I was introduced to you guys by a guy named Santini. He raves about Renovo Financial. He's like, man, they're like the easiest lender to work with. I know that we're doing our first deal right now as well, too, and pretty good process. So for our viewers out there that don't know what a DSCR loan is, what
Mhm.
is it? What does it stand for? Who
Yeah.
does it benefit?
Yeah, and it gets a little bit nerdy if you don't mind, and the jargon it can sound like I'm speaking a different language sometimes. So if you ever want me to stop or really pause on something and break it down, just let me know. But DSCR stands for debt service coverage ratio, and what that means is, does your gross income or your monthly rent cover your responsibilities in terms of expenses, and one of those being the principal and interest, or just interest if it's interest only, your obligations to cover that on the loan. So what we're looking at on single family assets or 1 to 4 units is DSCR, debt service coverage ratio, on PIDIA, based on PIDIA, and PIDIA principal, interest, taxes, insurance, and association fees if there's any, like an HOA. And so what we do is we take your gross monthly rent and we deduct all those expenses, the loan itself, the payment, the principal and interest, the taxes and insurance that you're responsible for on a monthly basis, uh, and, and association fees if there's any. And once you break that number down, you should be at a 1:1.00 for single family 1 to 4 units. And what that means basically in layman's terms is your property cash flowing a single dollar at the end of the month, after you've made your payment and you have your taxes, insurance, association fees.
So basically, let's give an example. Let's say your PIDIA
Mm-hmm.
is $1,000 a month,
Mm-hmm.
and let's say
Mm-hmm.
you collect $1,000 a month. At that
Mm-hmm.
point, you're at a break-even standpoint, which means the property would qualify, right?
The property would qualify. we want to give our investors the tools to, either cash out in some situations if it's a refinance, or acquire properties that are cash flowing. And especially on a 1-to-4 where you're making principal payments, you're increasing your equity position in that loan. And it allows you as the investor to really scale your business and go out and acquire more properties. But also with our underwriting that's very thorough, but very fair and very quick, we're protecting you as the investor and making sure that you're not making a bad decision and that you're not getting into a property where you're losing money on a monthly basis.
So, in other words, like in a traditional loan scenario, like the lender wants W-2 taxes, they want W-2, they want taxes, they want to source the funds, they want to know all this extra stuff. How different is this from that?
Very different. We're a lot easier on the underwrite. We're focusing mainly on the asset, especially when it comes to DSCR. We're looking in terms of the borrower, it's really mostly credit score. We want to be over a 680, and your rate is going to vary based on where your credit score is. And the other indicating factor of what the rate is going to be your leverage, your loan to value. If you want a maximum cash out refinance at 75% loan to value, your rate's going to be higher because you're sucking equity out. Your leverage, higher leverage, it's a higher risk essentially for the lender. The rate's going to be adjusted accordingly higher. Now, if you have great credit, you don't want cash out, you want a rate and term refi, or you want to put 25, 30% down, your rate's going to be really good, especially even in this market right now when the interest rate environment's high. You can still get in the low to mid sixes right now on a good DSCR rate.
That's awesome. Now, the LTV is important like on a cash out, or is that important on purchase money? Like meaning like let's say that I'm buying a property for $100,000
Mhm.
and the property meets the 1-to-1 ratio. Um, does that mean that would I be able to get all the $100,000 out in that scenario, or would I only be able to get $75,000 out?
On a purchase, you would get an $80,000 loan. You can get 80%. On a
Okay.
refinance, you could get all $100,000. We call that 100% LTC, 100% loan to cost. I've had situations where we go well over 100%. If you've owned a property for 5, 6, 7, 10 years, a ton of equity has been built into it. And we can get all of that, everything you've ever put into it, including rehab costs or whatever, and more out of it. So we go over 100% LTC on refis.
There's a difference between loan to value and then loan to cost, basically.
Yeah, and from the surface level, for the client facing level, we're really just looking at LTV, is loan to value. And on a purchase for us, that's 80%. So you'd put 20% down. And on a refi, we can go up to 75%.
And it doesn't matter basically like if you just got a smoking deal on a property and you're doing almost like the BRRR method, as long as you have the 25% built-in equity, the money doesn't have to come out of your pocket, basically. So
No,
it's basically a perfect product that goes with the BRRR method, basically.
it's a perfect product that goes with the BRRR method. And now on the BRRR method, you're fixing, you're buying, you're fixing, and instead of flipping, you're holding, right? And you're going to
Yeah.
portfolio this. So we have a really strong, and I know we're not here to talk about fix and flip loans. Might as well give it a pitch while I'm here. But we do a strong fix and flip program as well. So I would recommend if the property has deferred maintenance or needs rehab, you would do the fix and flip loan with us. We have no prepayment penalty on that, no interest requirement for periods of months. You do the fix with us. We are already underwritten the property for that acquisition, and now we can just turn it right into the DSCR loan because we're already familiar with the property. We're familiar with you as a borrower. We don't need any seasoning, which is a requirement of Fannie, Freddie, and other lenders. We just flip it right over the DSCR.
And then what about like income or W-2s or tax returns? I know I briefly talked about that at the beginning,
Yeah.
but do you guys not require that or just not pay attention to that?
We do not require it. Now, if we're talking about doing millions of dollars of loans together, At a certain point, we're going to want to see that you're at least current on your taxes and that you filed them. We're not so much, we're in the investment lending business, and all of our clients are investors and entrepreneurs, and we're very understanding that most everyone writes off everything they possibly can on their taxes. So we're not really looking at an income level, a net income level on taxes. We just want to know, hey, if we're giving you $1 million, you file your taxes and you don't have any tax liens or anything like that. But generally speaking, if we're doing properties, 100, 200, 400,000, even up to $1 million, we're not even asking for tax returns. We will look at your last 2 months bank statements and see how much liquidity you have on hand. But our requirements there are in line with the property, just to make sure, hey, do you have like 3 months reserves in the tank? Like if your tenant moves out and the property goes vacant, we want to make sure that, you're not able to pay your monthly payment.
So just for our viewers to understand, like basically the DSCR loan is if you collect $1,000 worth of rent and your monthly obligations are
Mm-hmm.
$1,000, you
Mm-hmm.
basically qualify for the property as long as you have a 680 or above. How does this differ from multifamily, or do you guys do multifamily as well too? And
We
what
do.
is considered multifamily?
Yeah, so we do multifamily as well. We consider it 5 units or more, so 5 plus we call it, and we do up to 50 units in a multifamily housing, and that's kind of market dependent, really. Like 50 units in California, depending on the market, at 250K a unit, like those are big loans, and it's going to require
Yeah.
a certain type of investor. But say like in the 5 to 12 space or 5 to 20 space, we're very comfortable there. And instead of running DSCR off PIDIA, we're now running DSCR off NCF, and NCF is a net cash flow. Those models are a little bit more complex. It takes a little bit more of a experienced borrower to understand what goes into that and to have the right pro formas and models to do that. But at the same time, I have a great senior credit analyst. If it's a 5 unit, someone's first 5 unit or first 8 unit or 12 unit, we're able to help them through that process to get the underwriting where it needs to be for them to get the right loan that fits their needs.
I love it. So walk us through the process. How does the process of like, I found the right property, how long does a DSCR loan take? Is it like the same as a traditional loan? Is it faster? Is it lower, slower?
Mhm.
And then who determines the rent as well too? Like meaning, could I just tell you, hey, my cousin's renting it out for $10,000.
Very
Here's a
good.
lease agreement, or is there an appraisal done on that?
Yeah, very good question. So, um, we are very much quicker than a Fannie Freddie or conventional lender. On a refinance, we typically take, I would say, comfortable between 2 and 3 weeks. On a purchase, we can move quicker than that because we're, customer service oriented and we want our investors to win, and we prioritize those on the list and get them done quickly. What we do need on a single family or 1 to 4 unit is an appraisal. And how we calculate our DSCR with the gross rents is we either take 100% of the market rents or the number that's the lease in hand. So, like your lease from your cousin, whatever it is, we look at that and we look at 100% of the market rents and we take the lesser of the two, right? And so if your cousin's paying you 10,000 and it's not really legit, we look at the appraisal and we say, what are the market rents? But Jose has a lease in hand, so he is getting payments. So we'll take 100% of that market rent value. Now, if the unit's vacant or we don't have a lease in hand, we look at the market rents and we take 90%. We give a 10% haircut. We take 90% of the market rent value to evaluate our gross monthly rents.
Now, are all DSCR loans the same regardless of which company do you work with? Like, meaning, do they all look at it from a 1-to-1 ratio,
No,
or how does Renovo differ from the other companies as it relates to that?
a lot of lenders have different requirements. You know, I think a Fannie Freddie or conventional bank is typically looking for a 1.2 or a 1.3 DSCR, which is basically a higher ratio, which will lower your loan amount, which will lower your leverage. Um, and in those cases, they might give you a better rate. Right now, we're pretty dang close. You know, mid sixes is, I think, pretty fair for rates right now. Um, how we differ in underwriting is a lot of those banks use AMCs, appraisal management companies. They third party to people that do conventional loans. We like to be direct to our appraisers that know the market well, that know investment product well. And so we're able to communicate, end purpose and what this loan is for, and what it's tailored to, and that it's for us an investment purpose real estate lending company. So when you do that and you work with people directly, as you've probably experienced, you have more control over the process, and things move a lot quicker and are more streamlined.
Yeah. What about like all, I mean, all this sounds great. Like, are there any negatives to like a DSCR loan, or are there anything that, yeah, any negatives to it?
The negatives would be likely pricing. You're going to pay a little bit of a premium for not having to go through conventional loans, or paying or showing tax returns, or showing proof of income. Right now, that difference is not that much. You know, on the low side, we're in the mid sixes, I would say. On the high side, we're in the low eights. That's all depending on how, what your credit is and what leverage you're taking. And we do have an origination fee that ranges from 1.5 to 2 points, which is 1.5% or 2% on the total loan amount.
Yeah. What about term? Like, are these rates interest only? Are they principal and interest? And also, like, are they 30-year loans? Are they 15-year loans? Are they 10-year loans? What does that
Yeah,
look like?
yeah. So we do have several options. We have a 30-year fixed, and that's principal and interest. And we have a 5, 7, and 10-year arm that we can go on multi-unit, the 5+ with interest only. Um, and so those are the options. The 30-year right now for single family is by far the best option in terms of pricing. You know what your rate's going to be, you know what your payment's going to be every month for the next 30 years, even though no one's going to keep it for that long in most cases.
Hmm.
But it's a safer loan, and the interest rate difference between a 30-year fix and say like a 10-year arm on a single unit is not enough to persuade someone to go for a 10-year arm.
Yeah.
Um,
What about like do you guys, I know for some lenders, um if it's a duplex, they'll factor in the rent on the duplex, but in some loans, if there's an ADU, they won't really use the income on the ADU in California. Do you guys, would that count as income, the accessory dwelling unit?
Yeah,
Um
yeah, we use ADUs. We treat it as another unit. If it's a one bed, one bath, we treat it as a one bed, one bath. If it's a studio, we treat it as a studio. Um, we can only really underwrite to the data that's available and out there. So, as long as the market has good comps in the area, and it doesn't need to be for ADUs, it just has to be like for unit. Then we're in a good position.
yeah. What about like any prepayment penalties on DSCR loans?
Yeah, I was actually going to bring that up. The DSCR loans have a standard 5-year waterfall prepayment penalty. So that is structured 5, 4, 3, 2, 1. That means that if you pay the loan off in the first year, you're going to be assessed with the 5% penalty. In the second year, a 4. In the third year, 3. The fourth year, a 2. And the fifth year, a 1. Um, that's the standard prepay setup. We can buy that down to a regular 3, 2, 1 waterfall, a 3 in the first year, a 2 in the second, and a 1 in the third. However, on average, it increases your interest rate by about 30 basis points, or 0.3%,
Hmm.
which can affect your DSCR, which can affect your total loan amount. So you really want to be confident in what your exit strategy or your business strategy is with these loans. If you intend on keeping them for more than 5 years, I would do the 5, 4, 3, 2, 1. If you're not sure, you think rates might come back down in the next year or 2 or 3 years, then maybe a 3, 2, 1 might be a better option. I can tell you, I don't think rates are going to get back into the twos or threes anytime soon.
Hmm.
Um, Having a rate in the sixes, where you feel comfortable and you're already cash flowing, isn't the end of the world if you're going to plan on keeping that property for a long time.
Yeah. Is there a limit as to how many DSCR loans you can do? Like, I know for some traditional lenders, they have a limit of 10 loans. Can I get 1,000 of these if I find
Yeah,
1,000 properties?
you can get 1,000 of these if you find 1,000 properties.
Mhm.
We love cash flowing assets. They're very secure, and they're cash flowing, so they're in a good place. We will like definitely evaluate that. Like once you get to 5 or 10 of these, what kind of shape are you in, like, business wise? But we don't set a preset cap on it. We get a lot of business from clients that have it maximize their exposure with banks, and they've got 10 or whatever the new requirement is, and they move over to us because we're much easier and don't have limits to how many DSCR loans they can have.
Do people ever default on the DSCR loans, or do they like do those get foreclosed on less than like a traditional, or what does that look like if there's any insight on that?
Gosh, it's so rare. We really try to focus on underwriting our clients well, and meeting face to face or over Zoom, or having good discussions over the phone to mitigate that risk. But I mean, if you're putting 20% or 25% into a property and you can't make
You're
your
covered.
payment, or it's like the chances of you letting that go into a bad place are really low. And we really pride ourselves on our defaults and our missed payments. So we have a really strong portfolio right now. Knock on wood.
I love it. I love it. Now, the only last thing that I was kind of thinking about is I know that single families are PITIA. I know that multifamily is based on net cash flow. What is that formula of net cash flow? Is it like how is that different than PITIA?
Yeah, we're looking at any capex, like any deferred maintenance or improvements on an annual basis. We build that into the calculation. Maybe the properties, on a multifamily have washer and dryers or garages that rent for more. That's a positive. You're going to see that's part of your positive gross monthly income. So we can
Yeah,
take that into consideration too. On the downside, you got leasing commissions, reserves, um, stuff that really on a scale you have to take into account versus a single family asset. So we'll be looking into that more of like looking into the 5+ as it's a business versus just a single asset.
I love it. And then just to confirm on the PITIA, you guys don't take any vacancy factors into account, and you guys don't take any like maintenance into account. It's just PITIA and gross rents, basically.
Yeah, we do calculate on the back end, like internally, some deferred maintenance. Like we look at the pictures from the appraisal and we see, hey, is this place did they do the BRRR method? Did they acquire it and fix it up real nice? And is it new appliances, and is it new laminate flooring, or what's the situation here? Or is it dilapidated a little bit, in poor condition? Are they going to need some more money every year to keep things up a little bit? We assess that internally, and if it's a great enough factor to consider in the calculations we do, but generally speaking, we're just looking at what the cash flow is.
I love it. Anything else that we should know about the DSCR loan, or anything else that you think would be important?
I think we just about covered it. If you have any questions, you want to run any mock scenarios or live scenarios by me, I'm always available for that. I've got a great team, from production assistant to senior credit analyst and closer, that helps everything along the way. We do, a handful of these at least a week, my team and myself personally in these markets. So I'm very comfortable and confident in the process and in the product.
I love it. I love it. Good. So for our viewers out there today, we had Brendan Ochinero. He is with Renovo Financial. They do the DSCR loans, but they also do flip loans as well too. We're actually working with them personally on a flip loan, and also they are part of a mastermind that we have, which is Collective Genius, so very reputable people. If people wanted to get a hold of you, Brendan, what is the best way for them to do that?
Yeah, thanks for saying that, Jose. Like I said, we're very focused on client facing and customer oriented. My personal email is Brendan, BRENDAN, at renovofinancial.com, and my number is 858-232-2501. And I'm happy to speak to anyone personally, and go through scenarios or talk about their business, and where we might be a fit to help them grow.
I love it, man. So I want to say thank you, Brendan, for obviously coming on the show. Thank you for explaining the DSCR loan. I think it's a phenomenal product. I wish I would have known about this product like 5, 6 years ago. I
Yeah.
think it would have helped me scale like a lot more. And it's interesting because now that like I'm taking my realtor hat off
Yeah.
and getting more involved with the investors, I find out that there's a lot of stuff that as a realtor I may have been missing out on. And I'm
Yeah.
lucky and glad to be in relationships with people like you. So I want to say thank you for that. For our viewers out there, if you've enjoyed the podcast today, we had Brendan Ochinero, Renovo Financial. What is a DSCR loan? Make sure to hit that subscribe button. And if you feel that this episode will be helpful for a friend, make sure to hit that share button. And thank you guys. And until next time, and thanks again, Brendan.